Welcome to vTalkInsight, Market Drivers Daily for December 31st, 2025. As we close out the year, three forces are shaping market thinking. An AI investment wave moving from pure infrastructure into monetization, a surprisingly resilient global growth backdrop, and a Federal Reserve easing cycle whose path remains contested. Let's look at how those drivers are feeding through to asset prices and portfolio risks. Across markets, artificial intelligence remains the dominant narrative, but the focus is evolving from hype toward execution, funding, and constraints. Late last week, the conversation centered on concentration risk in a handful of AI leaders. Now, fresh signals show the investment cycle broadening while the real economy impact is still only gradually emerging. AI is moving from niche tools to a core layer across industries, with players like NVIDIA and Apple expected to accelerate consumer and robotics adoption. Yet current evidence suggests it is not meaningfully driving job losses or hiring freezes, which are still mostly linked to broader macro conditions. The key takeaway is that AI is increasingly a macro driver through capex and earnings rather than via immediate labor market disruption. The infrastructure build-out behind this shift is still in full swing. High-quality semiconductor names geared to AI, including NVIDIA and Broadcom, are expected to keep outperforming into 2026, helped by a view that the AI chip market is far from saturated and that earnings forecasts still have room to move higher. Demand for NVIDIA's products in Asia continues to exceed available supply by a wide margin, and some analysts estimate that every dollar spent on its chips can generate roughly $8 to $10 of value across the broader tech ecosystem. Major tech firms are planning to lift total capital expenditure from about $350 billion to $450 billion next year, much of it toward data centers, and companies like Caterpillar are now seeing around half of their revenues tied to that data center build-out. This wave is also spilling into utilities and construction equipment, underlining how AI capex is becoming a multi-sector growth engine. Financing this supercycle is pulling in enormous balance sheets and reshaping credit markets. SoftBank has now deployed roughly $40 billion into OpenAI, taking its stake above 10%, while OpenAI itself faces around $1.4 trillion of committed compute costs over the next 8 years, implying continued reliance on deep-pocketed partners such as Oracle and Microsoft. At the same time, investment-grade bond issuance from major tech firms has surged as they fund data center and AI infrastructure, raising questions about concentration risk in both credit indices and the broader economy. For now, the largest hyperscalers still show manageable leverage and strong coverage metrics, and banks are operating in a supportive environment with solid credit quality, active capital markets, and early efficiency gained from AI helping margins. The balance of evidence points to ample funding capacity today, but with a growing premium on scrutinizing who ultimately underwrites the long-dated cash flows behind AI projects. Within equity markets, leadership is starting to shift from the heaviest infrastructure spenders toward companies demonstrating clear monetization and productivity gains from AI. Meta is a case in point. It is dialing back the most speculative superintelligence research and pivoting toward practical AI that can lift near-term revenue, particularly through advertising and business services on its core platforms. The $2 billion acquisition of Singapore-based AI startup Manus, which added about $18 billion to Meta's market value in a single session, underscores investor enthusiasm for deals that can turn AI spend into cash flow, especially as WhatsApp evolves toward a multi-function app and small business tools are upgraded. Even so, Meta's share performance has lagged peers like Alphabet and the wider tech complex, highlighting ongoing skepticism about the timing of payoffs from its AI strategy. Elsewhere, many investors are refocusing on software infrastructure and cybersecurity names such as MongoDB, Snowflake, CrowdStrike, and Palo Alto, as well as on companies like Amazon and Salesforce, where AI-driven efficiency and recurring revenue are seen as underappreciated relative to current valuations. The AI theme is also creating unexpected winners and new market structures. Bitcoin miners that secured large AI infrastructure contracts with major tech firms have rallied between 200 and 300% as they build business models that are less tied to crypto prices and more to data center services. Applied Digital's share price, which is up more than 200% this year and jumped further on news of spinning off its cloud unit into a merger, shows how AI-focused restructuring can unlock equity value. On the market plumbing side, Grayscale has filed to convert its BitTensor Trust into an exchange-traded fund, aiming to bring decentralized AI tokens into mainstream markets, while Nasdaq has applied to enable trading of tokenized equities and ETFs, potentially paving the way for 24/7 equity trading more akin to crypto markets. Coinbase is positioned at the intersection of these trends, with expectations that regulatory clarity, potential Fed rate cuts, and new products such as prediction markets and international expansion could all be catalysts into 2026. Despite the optimism, several fault lines are emerging that investors are watching closely. Energy availability is now flagged as the main bottleneck for further data center expansion in the United States, with nuclear frequently cited as a potential solution, and persistent power constraints could cap the pace of AI infrastructure growth. The IPO market's recovery is described as fragile and heavily dependent on a handful of large AI-related listings. A high-profile deal that struggles or fails could ripple through banks, tech valuations, and broader capex plans. There is also geopolitical and regulatory risk, illustrated by Manus relocating from China to Singapore and distancing itself from Chinese operations to facilitate Western partnerships, even as its acquisition by Meta may invite scrutiny from both U.S. and Chinese authorities. Finally, the surge in tech bond issuance linked to AI leaves markets more exposed if growth expectations disappoint or if debt levels rise faster than cash flows. In summary, AI remains the central driver of the tech-led rally, but the story is increasingly about funding durability, power grids, and monetization, which sets the stage for how growth momentum evolves next year. The broader growth backdrop looks constructive as we head into the new year, although it remains uneven across regions and households. The U.S. yield curve has been steepening, with the 2-year yield around 3.46% and the 30-year near 4.8%, signaling shifting expectations toward firmer growth and slightly higher inflation over time. Bank of America strategists see multiple tailwinds for U.S. GDP next year, including ongoing fiscal support, the lagged effects of recent Fed cuts, AI-driven investment, more supportive trade policy, and easier comparisons after the prior government shutdown. At the same time, income growth is now outpacing inflation, which supports consumption, but the gains are heavily skewed toward higher-earning households, reinforcing a K-shaped recovery narrative. Outside the United States, several regions are emerging as important contributors to global growth. Germany is expected to outperform within Europe as it steps up spending on infrastructure and defense, while broader European equities have already seen Germany and especially Spain outpace U.S. benchmarks this year, with Spanish stocks delivering around 70% returns for dollar-based investors. Japan's recent economic strength is tied to fiscal reforms and stimulus, although rising tariffs and geopolitical tension with China are clear risks that could temper that momentum into next year. In China, extended subsidies for electric vehicles and consumer electronics are designed to prop up domestic demand and support related equity segments in the near term. Public-private partnerships are also playing a larger role, with the USCHIPS Act having triggered roughly $300 billion of semiconductor investment and a new $200 billion Department of Defense initiative aimed at strategic capital deployment. Together with Germany's anticipated fiscal expansion, these programs point to a firmer global capex cycle even as some countries try to rein in budget deficits through higher tariff revenues and tighter spending controls. On the ground, consumer and services data continue to confirm this growth story, albeit with clear divergences. Travel demand is projected to hit record levels this year, with around 122 million car travelers and 8 million air passengers, supporting strong hotel occupancy and revenues. Key hotel metrics, such as revenue per available room, are holding near last year's record highs, while major hotel chains and airlines, including Hilton and Delta, have been outperforming on the back of asset-light business models and sustained demand. Operators are seeing a shift toward online bookings and shorter reservation windows, prompting additional investment in digital platforms and dynamic pricing tools to capture late demand. Theme parks like Six Flags and United Parks are also expected to benefit from evolving offerings and immersive experiences into 2026, with some analysts arguing that the market still underestimates this earnings potential. Behind the scenes, U.S. employment growth is increasingly concentrated in healthcare and skilled trades, while manufacturing and retail remain sluggish because of tariffs and policy uncertainty, and higher-income consumers are driving most of the spending resilience. Looking ahead, the base case embedded in markets is for robust global growth with inflation that is persistent but manageable. Strong nominal GDP is expected to continue, supported by solid real activity, resilient consumption, and a substantial business investment boom tied to AI and related infrastructure, which in turn lifts revenue prospects for both public and private companies. Recent strength in copper and precious metals, alongside a softer U.S. dollar and relative underperformance of U.S. assets, points to investor expectations for durable global expansion and some concern about currency debasement under a more dovish Fed. The main risks to this constructive picture are a sharper slowdown in AI-related capex, an escalation in tariff and trade tensions that would weigh on manufacturing and Japan's outlook, and a potential loss of consumer momentum if the gains in real income fail to reach lower-earning households. For now, though, the growth narrative remains a tailwind for risk assets, and it is directly feeding into how central banks calibrate the next leg of the easing cycle. Monetary policy is already in easing mode, but the impact on the real economy and markets has been more muted than many expected. The Federal Reserve has cut rates several times in recent months, amounting to about 75 basis points, with the explicit aim of stabilizing employment and supporting activity. So far, there has been little evidence of a meaningful pickup in hiring or job creation, and recent cuts have not significantly reduced market yields or borrowing costs, leaving many households still facing high mortgage, credit card, and auto loan rates. The benefits appear uneven across sectors, with small businesses and variable rate borrowers seeing more relief, while areas like housing remain relatively insulated because of the prevalence of fixed-rate mortgages. This helps explain why clients remain highly focused on the timing and magnitude of further rate reductions. The path ahead for policy is increasingly contested. Market-based probabilities suggest a low chance of a January cut and roughly a coin flip for March, reflecting mixed economic data and uncertainty about how quickly inflation will return toward target. Some forecasters expect the Fed to keep rates unchanged through the first half of the year due to sticky inflation, then potentially deliver 2 cuts in the second half if profit margins come under pressure and tariff effects fade. Others argue that more than 1 cut next year is likely, especially if the labor market weakens further and inflation remains subdued, and a Fed official has recently downplayed the risk that the latest uptick in unemployment signals an imminent recession, citing ongoing and expected easing as a buffer. There's also a scenario in which the Fed trims rates twice more by 2026, bringing the real policy rate closer to 3%, which some see as a neutral level consistent with post-war historical medians. Overlaying this rate debate is a significant leadership question at the central bank. Political uncertainty around Chair Powell's future and the upcoming nomination of a new or returning Fed chief are creating policy risk, as markets weigh whether the next leader will preserve the Fed's independence and commitment to the 2% inflation goal. A shift in the committee's composition, especially if Powell steps down, is widely seen as increasing the odds of a more dovish stance, with a higher probability of lower policy rates, a steeper yield curve, and lower real rates into 2026. Indeed, the U.S. curve is already steeper, with the 2-year yield near 3.46% and the 30-year around 4.8%, and investors broadly expect low interest rate volatility and easy financial conditions through at least the first half of 2026. At the same time, policymakers remain divided, with some advocating aggressive easing and others preferring to stay on hold, and the main upside risk to rates is a renewed inflation surprise that could force a pivot back toward hikes. These policy dynamics are feeding directly into cross-asset pricing. Expectations that the Fed will continue lowering rates, albeit at a slower pace, help explain why some investors favor locking in yields at the long end of the Treasury curve, anticipating that coupons available today may look attractive if unemployment rises and cuts continue. A more dovish trajectory also points to a weaker U.S. dollar over time, particularly if U.S. policy converges with global easing trends, which would tend to support non-U.S. assets, exporters, and demand for base and precious metals. Recent gains in copper and gold, together with talk of de-dollarization, reflect both robust global growth expectations and concern about currency debasement under prolonged easy policy. In crypto, Fed cuts projected for 2026 are seen as a key driver of renewed risk appetite, with expectations for higher token prices and increased activity in crypto-related equities, including platforms like Coinbase that also stand to benefit from regulatory clarity and new product launches. The main macro risk to this benign backdrop remains a scenario in which inflation re-accelerates, forcing the Fed to reverse course toward renewed tightening, which would challenge both the growth and valuation assumptions currently embedded in markets. Bringing this together, the AI investment cycle is still powering a tech-led rally, but the focus is shifting toward monetization, funding durability, and physical constraints like power and grid capacity. Global growth indicators, from European equity leadership to record travel demand, point to a resilient and increasingly broad expansion, even if it is uneven across regions and income groups. The Fed, meanwhile, is deep into an easing phase, yet the transmission to hiring, borrowing costs, and the dollar remains patchy, and the leadership question adds an extra layer of uncertainty to the rate path. As you position into the new year, the key questions are how sustainable AI, capex, and profitability prove to be, which pockets of growth can withstand policy and trade shocks, and how different rate cut trajectories could reshuffle relative value across curves, currencies, and risk assets. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.